Welcome to Tech Money Madness, your daily U.S. stock market podcast. It is Thursday, June 18th, 2026.
And it is a big day.
It really is. I mean,
Yeah.
so imagine a day where, global peace is suddenly declared in a major region.
Right.
Gas drops below $4 a gallon, and the world's biggest tech companies just absolutely surge.
You'd assume the financial markets would be, like, universally euphoric.
Exactly.
Yeah.
But if you look closer, the market for small businesses actually plummeted to set.
Yeah, it dropped pretty hard.
And on top of that, the Federal Reserve is actively threatening to raise your borrowing costs. So yeah, we are doing a deep dive into the latest daily market briefing to try and make sense of all this.
It is basically the absolute definition of a whiplash market, right?
Oh, 100%.
We're watching these fundamentally conflicting economic forces just collide in real time. And it's scrambling the usual instruments we use to measure financial health.
It really is. And just a quick reminder for you listening today, today's source material is heavily driven by geopolitical policy.
Yeah. Very heavy on policy today.
Right. So we are unpacking a new Trump administration tech initiative and a major U.S.-Iran diplomatic deal. But our mission on this deep dive is to look strictly at the financial math, right?
Yeah.
Not the politics.
Absolutely. We take absolutely no political sides here.
None at all. We are not endorsing any policies. We're solely analyzing how capital is reacting to these new policies, period.
Because, capital operates without a political party.
Yeah.
It just simply reallocates based on newly introduced risks and, well, newly created opportunities.
Right. The money just moves.
Exactly. And our job is to trace where that money is moving and figure out why.
Okay, let's unpack this. So let's start by looking at what actually pulled the broader indices out of the red today.
Yeah.
Because we did see a significant rebound on the surface.
A really strong rebound.
Yeah. The Nasdaq 100 closed up an impressive 1.69%.
Huge day for tech.
The S&P 500 jumped 1%, and the Dow Jones advanced 0.4%. But, the Russell 2000 was down 0.7%. We'll get to that later.
Yeah, that divergence is key.
But the catalyst for that baseline optimism, for the big indices anyway, was a profound geopolitical shockwave.
Yeah, the primary driver behind the broader market optimism today is, well, it's the landmark U.S.-Iran agreement ending hostilities.
Right.
This represents, a structural shift in global risk assessment.
And the sources detail the immediate real-world impacts of this deal. Like, the Strait of Hormuz is officially reopening.
Which is massive.
Right. And concurrently, the U.S. Navy has officially ended its blockade of Iran's ports and coastal areas. This is the physical unblocking of global trade routes.
Yeah. And to understand the market's reaction, you have to consider the underlying mechanics of the Strait of Hormuz.
Okay, break that down for us.
So roughly a fifth of the world's total oil consumption passes through that specific narrow choke point.
A fifth.
A fifth. So when military conflict threatens that area, commodities traders basically price in a risk premium.
Right, like an insurance policy.
Exactly. It's an insurance markup on the cost of crude oil because of the potential for a sudden supply disruption.
Makes sense.
But when the U.S. Navy lifts the blockade and these diplomatic resolutions are signed, that risk premium just evaporates overnight.
And we really saw that evaporation in the data today, didn't we?
Oh, big time.
Because the oil prices tumbled 2.2%. They slid right down to $75 a barrel.
Which is a huge relief.
Right. And for the average consumer listening, that translates directly to gas prices falling below $4 per gallon.
Yeah, people are going to feel that at the pump immediately.
It feels like, unclogging the world's most critical economic artery. Suddenly, the supply is just flowing again without obstruction.
That's a really good way to put it.
But I have to ask, does fixing the oil supply side actually fix the broader market economy?
Whoa.
Or is this simply, a temporary sugar rush for investors who were terrified of crude spiking to $120?
What's fascinating here is the distinction between a relief rally and a structural rally.
Okay.
Your artery analogy captures the mechanics perfectly. Unclogging the artery prevents an immediate heart attack. Right. That is the relief. The fear of an energy-driven recession dissipates. So algorithmic trading systems and Hukin investors, they step in to buy the dip.
Because the disaster was averted.
Exactly. But a relief rally only lasts so long. Once the immediate panic fades, the market kind of looks around and asks, well, what is actually driving sustainable long-term growth?
Because cheaper energy lowers input costs for manufacturers and shipping companies, sure.
Yeah, I know margins.
But it doesn't, invent new products or generate new consumer demand all on its own.
Precisely. It creates a favorable environment, but the underlying sector trends dictate whether a rally actually has legs. The drop in oil gave the broader market permission to breathe, but it didn't create the explosive growth we saw in specific sectors today.
And those underlying structural trends are exactly what drove the Nasdaq up nearly 1.7%.
Yeah, that was wild.
Right. The real heavy lifting wasn't done by cheap gas. It was done by domestic silicon. The narrative shifted so dramatically from, global geopolitical relief to aggressive domestic industrial policy.
Yeah, we saw an explosive surge in the semiconductor sector, and it's really driven by a complete reimagining of the global technology supply chain.
Because of the big announcement. President Trump announced that Intel is officially partnering with Apple to design and build chips directly here on American soil.
Which is a huge pivot.
It is.
Yeah.
I mean, I think of Intel like a legendary legacy rock band that just hasn't had a chart-topping hit in a decade.
That's incredibly accurate.
Right. Like they have the stadiums, they have the history, but they've just lost the cultural momentum.
Yeah, they've been sidelined.
But then suddenly they announced they're getting back together for a multi-billion-dollar tour, and their opening act is the hottest pop star in the world, Apple.
Right.
The cultural and economic relevance of Intel was essentially redefined overnight.
And the capital markets certainly endorsed that narrative. I mean, Intel's stock surged a staggering 10% on the news today.
10% for a company that size.
Yeah, to move a legacy giant's market cap by double digits in a single trading session.
That's billions of dollars.
Exactly. It requires billions of dollars of institutional capital flowing in simultaneously.
And that rising tide really lifted the broader AI and silicon sector.
It did.
We saw AMD jump 3.9%. Broadcom, trading under AVGO, was up 4.24%.
Great days for both of them.
And we should note, our sources mentioned Tesla was also one of the most active stocks today.
Yeah, Tesla was moving.
But it was experiencing what they call a high beta bounce. And for those less familiar, high beta simply means the stock is inherently more volatile than the baseline market.
Yeah, it swings harder in both directions.
Exactly. So because of that volatility, it amplified the overall upward momentum today. But the briefing makes it clear that this bounce kind of masks deeper, lingering questions.
Oh, definitely.
Questions about their full self-driving tech, their shrinking profit margins. So not all tech is flying on pure foundational fundamentals right now.
No, and Tesla often trades on its own unique speculative momentum, kind of decoupled from traditional valuation metrics.
Sure.
But returning to the Intel and Apple partnership, the mechanics of this shift are just monumental.
How so?
Well, for decades, the technology industry's playbook was rigid. You design the sophisticated chips in California, and you manufacture them in Asia.
Right, relying almost entirely on Taiwan.
Exactly. Repatriating that supply chain requires building new semiconductor fabrication plants, or fabs, inside the United States.
But wait, building a new fab from scratch takes years.
Many years.
You have to pour specialty concrete source, incredibly complex, multi-million-dollar lithography machines.
Yes.
And staff the facilities with highly specialized engineers. We are talking about massive capital expenditure before a single microchip ever rolls off the assembly line.
Absolutely.
So why is the market rewarding Intel with a 10% bump today for a factory that essentially does not even exist yet?
Because the market operates as a discounting mechanism. It constantly looks 12, 24, even 36 months into the future and prices those future realities into today's stock price.
Oh, I see.
A 10% jump doesn't mean investors believe Intel will generate 10% more revenue tomorrow morning. It means the market is pricing in the certainty of this supply chain overhaul.
The certainty. Yeah. Because the policy is there now.
Exactly. When you align the U.S. government's policy, Apple's virtually limitless capital, and Intel's foundational infrastructure.
It's a done deal.
Right. Domestic silicon independence goes from a theoretical possibility to an absolute inevitability. The market is rewarding the de-risking of Apple's future hardware supply.
Because AI needs that hardware.
Yes, the momentum surrounding artificial intelligence requires guaranteed hardware, and this deal promises that security.
Okay, so the market is eagerly rewarding companies promising to pour physical concrete and build tangible goods in America.
Yeah, they want the real stuff.
But there is a dark side to this sudden demand for physical reality, isn't there?
Very much so.
Because if capital is aggressively flowing toward tangible manufacturing, it is actively draining away from companies surviving purely on hype or intangible promises.
It's a zero-sum game in some way.
And we saw that divergence perfectly illustrated today. While the Nasdaq soared, the Russell 2000, which tracks smaller, often less profitable companies,
Right.
it actually fell 0.7%.
Yeah. Gravity's pulling down sectors that lack immediate, tangible cash flow. The tolerance for speculation is just evaporating.
And nothing represents that financial gravity quite like the SpaceX IPO hangover.
Oh, brutal. Just brutal.
The stock sank for a second day in a row. The average post-IPO buyer is now almost entirely underwater.
Yeah, if you bought into the hype on day one, your portfolio is definitely flashing red.
Why is it struggling so much right out of the gate?
Well, the transition from the private venture capital ecosystem to the public equity markets is notoriously unforgiving.
How are they different?
In private markets, valuations are frequently built on vision, total addressable market, and sheer ambition. A company like SpaceX can command an astronomical premium from venture capitalists for promising to colonize Mars or revolutionize global satellite internet.
Because VCs love a moonshot, literally.
Literally. But public equity investors demand something far more mundane. They want positive cash flow and sustainable profit margins.
And the discrepancy in the briefing's numbers today is just jarring.
It's huge.
SpaceX's private valuation was driven by those ambitious growth projections, right? Making it the 6th most valuable company in the world.
Yeah.
I mean, it even slipped past Amazon's market cap at one point recently.
Which is insane to think about.
Right. Yet they only generated $18.67 billion in revenue last year. And against that, they posted a $4.94 billion net loss. They burned nearly $5 billion.
Yeah, and you just cannot sustain the valuation of the 6th largest company on the planet while incinerating $5 billion in capital.
Public markets won't have it.
No. Public investors look at a peer like Amazon, which generates hundreds of billions in revenue alongside substantial, consistent profits.
Right. Real cash.
The financial math simply does not reconcile for SpaceX right now. The public market is forcing a harsh, immediate repricing of ambition.
And that repricing isn't limited to space exploration. We're seeing a bloodbath down here on Earth in the consulting sector, too.
Oh, the consultants had a terrible day.
Accenture, which is a titan in the corporate advisory space, they cut their revenue guidance. And the punishment was swift. Their stock plummeted 17.4% in a single day.
If we connect this to the bigger picture, it really highlights a profound shift in corporate psychology.
Yeah.
Because Accenture's drop dragged down peers across the board. We saw CTS fall 10.4% and GLOB drop 9.9%.
But why is the punishment so severe for the consulting sector right now? I mean, if a company misses revenue by a few percentage points, a nearly 20% drop in share price seems almost catastrophic.
Well, consider the fundamental nature of consulting. It is the ultimate discretionary operational spend.
Right, it's nice to have, not need to have.
Exactly. When corporate boards grow anxious about their own cash flows, perhaps because capital isn't as cheap as it used to be, they don't shutter their manufacturing plants or cancel their crucial raw material orders first.
No, they got the fat.
They cancel the multi-million-dollar strategic advisory contracts. Consulting revenues basically act as an early warning radar for broader corporate belt-tightening.
So we're witnessing a sudden market shift where investors are abruptly demanding profitability today, not in 2030.
Yep. Yeah.
They want to see tangible goods, operational factories, and positive cash flow, and they are actively punishing anything that resembles a luxury corporate expense or like a decade-long science project.
Absolutely. The era of the zero interest rate phenomenon, where capital was essentially free and companies could fund billion-dollar losses indefinitely to capture market share, that era has definitively closed.
Which brings us to the ultimate irony of today's trading session.
The big contradiction.
Amidst the euphoria of historic Middle Eastern peace deals, cheap consumer gas, and a monumental American tech renaissance, there is a very dark macroeconomic cloud looming over the financial markets.
The Federal Reserve.
The Fed.
They remain the inescapable gravity acting on every single asset class we have discussed today.
And our sources highlight that Fed Chairman Kevin Warsh delivered some incredibly tough talk on inflation yesterday.
Very hawkish.
And that hawkish tone is dictating trader behavior today. The Federal Reserve explicitly suggested that higher interest rates could still be in the cards.
And traders are taking that threat quite literally.
They are.
If you look at the Kalshi prediction markets, investors are currently pricing in a growing 50% chance of a rate hike in 2026.
50%.
It is effectively a coin flip on whether the cost of mortgages, auto loans, and corporate borrowing goes up even further.
So what does this all mean? Help me bridge the logic gap here. Because on the surface, this feels completely contradictory to the average consumer.
It really does.
Right. We established that the U.S.-Iran deal is pushing oil down to $75 a barrel. Gas is cheap again. If the baseline cost of energy is dropping, wouldn't that naturally lower inflation? Why is the Federal Reserve threatening to hike interest rates when everyday consumers are finally seeing price relief at the pump?
I know, it seems highly counterintuitive until you separate what we call headline inflation from the core economy.
Okay, what's the difference?
Headline inflation includes highly volatile categories like food and energy. So yes, cheap gas brings that specific headline number down.
Right.
But the Federal Reserve focuses intensely on the core economy. That's the underlying structural demand for domestic labor, services, and industrial materials.
Oh, I see. It's like trying to cool down your living room by cranking up the air conditioning, but someone just lit a massive bonfire in the middle of your kitchen.
Yes.
The AC is the cheap oil, right? Providing some surface level relief. But what exactly is the bonfire in this economy?
The bonfire is the multi-trillion-dollar capital expenditure boom we were just analyzing.
The chip.
Yes. When Intel and Apple commit to repatriating the semiconductor supply chain and building domestic fabs, they require an army of highly skilled engineers.
Right.
They need tens of thousands of construction workers, raw steel, specialized concrete, and heavy industrial equipment. That undertaking creates a ferocious surge in domestic wages and industrial demand.
Because all those newly hired workers have higher wages, which they then go and spend in the broader economy, driving up the prices of everyday services.
Exactly. Add in a booming stock market that creates a wealth effect, where investors see their portfolios rising, they feel wealthier, and they increase their discretionary spending. And you have an economic engine running incredibly hot.
So even though the fuel entering the engine is cheaper, thanks to the Middle East peace deal, the engine itself is revving so high it is in danger of overheating.
Yes.
Chairman Warsh is worried that the surge in tech and manufacturing will drive up wages and service costs, entirely offsetting the relief consumers are getting on energy.
You nailed it. The Federal Reserve's historical mandate is to take the punch bowl away, just as the party really gets going.
And it's getting rowdy.
Oh, it's a very rowdy party right now. With silicon supply chains moving fiercely back to the U.S. and institutional money flowing heavily into domestic infrastructure, the Fed is keeping the threat of a rate hike alive to ensure wage and service inflation does not spiral out of control.
Wow. Today's daily market briefing really is a masterclass in reading between the lines of the ticker tape.
It really is.
I mean, on one hand, we have geopolitical relief in the Middle East bringing down energy costs, and a massive push for American-made silicon sparking a huge tech rally.
Yeah.
But beneath that green index, brutal reality checks are battering newly public space companies and consulting firms, all while the Federal Reserve stands by with its finger hovering over the interest rate button.
It perfectly illustrates why looking at a single number like the S&P 500 being up 1% fails to tell the true story of your portfolio.
Right, it masks everything underneath.
Exactly. If your investments are heavily concentrated in speculative growth or corporate advisory firms, you are experiencing a brutal correction today.
Yeah.
But if you hold domestic semiconductors, you are witnessing a renaissance. Understanding the mechanics behind the news, the why and the how, is the only way to navigate this environment.
I want to leave you, our listener, with a final provocative thought to mull over as you review your own portfolio today.
Okay, let's hear it.
We are watching energy markets stabilize on a global scale, but at the exact same time, the world's most critical technology supply chains are fiercely retreating back behind domestic borders.
Yeah, that's true.
So are we entering an era where the biggest tech companies, the Apples and Intels of the world, start functioning more like sovereign nation states than traditional businesses?
That's a great question.
I mean, when your manufacturing deals require presidential announcements and fundamentally reshape global trade routes, you're playing an entirely different game.
You really are.
Well, that's all for today's episode of Tech Money Madness. Thank you for taking this deep dive with us today. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage. Take care.